All right. What's up, guys? I hope you're doing well. James here from jamesdforsythe.com. And so I just wanted to go over a recent speech given by Michelle Bowman again, mostly about the forward guidance that the Fed does, right? And so what I thought was interesting about this is she kind of breaks it up between like kind of implied and explicit forward guidance, and how that's kind of changes depending on, we'll say, the inflationary and economic environment at the time, right? And so, with that being said, we'll head right over to the screen share, right? So you guys can see it. And so, basically, just given that as of right now, you know that the target range for Fed funds is about 3 to 3.25%, and they've been basically hiking by 75 basis points to keep inflation down, right? And so basically, if we do not see that inflation is moving, my view, Joe Bowman's, continues to be that sizable increases in the target range for the federal funds rate should remain on the table. So, to bring inflation down in a consistent and lasting way, the federal funds rate will need to move up to a restrictive level and remain there for some time. And this was the part that they're really kind of, I guess, serious about it, to where they're really wanting to hold it there for quite some time. And that might lead to some kind of contradictions in what she says later with respect to it just being in the opposite direction. Basically saying, what if they stay restrictive for too long and then get behind the curve in that respect? Maybe the whole kind of concept of like a Fed pivot, right? And so to continue, however, it is not yet clear how high we will need to raise the Fed funds rate and how much time will pass before we begin to see inflation moving down in a consistent and lasting way, right? Because this is one thing you see them talk about, and quite a few of the governors in their speeches, basically about how they do not want to pivot too soon, right? And they kind of cite the 1970s in that respect, just with how much of a problem inflation can be and how it will basically just put more fuel on the fire to pivot too soon. So they want to be sure before they even think about pivoting, which is kind of where the whole thinking part of it kind of rolls into the whole forward guidance aspect of it. So, to be considered forward guidance, a statement does not need to be explicit about future policy actions or the timing of potential actions. It may be more qualitative in describing likely policy actions that may be taken in the future, and in some cases may only describe how the Fed will be thinking about its future decisions rather than signaling the likely future direction of policy actions, right? And this is kind of where, especially the thinking aspect of it, you see where, I don't know, I think it was a year and a half, maybe 2 years ago, when before they were raising interest rates, right? And it was like they're not even thinking about raising interest rates, was kind of the whole thing. I heard this a few times on Peter Schiff's podcast when I used to listen to it all the time, and he would always go on about, like, the Fed's not even thinking about it, raising interest rates, kind of emphasizing this point of kind of implicit um, forward guidance, right? And so the intent of all forward guidance is to influence the public's expectations about the FOMC's future monetary policy actions, and in doing so, affect longer term interest rates and broader financial conditions to help support a path for inflation and economic activity, right? And so that's the problem, is to influence the public's expectations, right? Hence the guidance part of it. Um, so to get a little more historical on it, so over about the past 10 years, the use of explicit forward guidance has become an integral part of the Fed's monetary policy toolkit. In fact, explicit forward guidance is generally seen by many as especially harmful when you use the committee's main monetary policy tool, changes to the Fed funds rate, is constrained. And basically what they mean by this is when it was held at the zero bound, there's not much you can do because you can't really decrease interest rates more, or I guess you could argue for negative rates, but the Fed has been rather, I thought, explicit in that they do not want to take nominal rates negative in that respect, because that's a whole new regime at that point. So, explicit forward guidance hasn't always been viewed as a helpful addition to monetary to the monetary policy toolkit, particularly before 2008, right? Excuse me. So basically, she attributes this to the different costs and risks that come with trying to guide the market in this way, right? And so you kind of have this, she says these costs and risks included the confusion and potential financial market volatility that could result if the public did not fully understand the committee's forward guidance, right? So if there's any form of confusion or if there's any form of confusion of what the Fed means, that can cause and induce kind of severe volatility in markets, right? Just from uncertainty, which when you deal with that amount of uncertainty, you need that amount of flexibility in terms of monetary policy, right? To kind of be able to take care of what you need to. Um, and this is spoken I say this kind of with the perspective of from the Federal Reserve itself, right? Not really placing any value judgments on whether or not they should be doing this to begin with, just kind of reiterating or kind of emphasizing their argument in a way, right? And so another common concern was that if the committee had to alter its forward guidance too frequently in response to rapidly changing economic conditions, its forward guidance could become ineffective, meaning that the public could heavily discount or simply disregard this guidance. Or worse, the public could come to question the committee's overall credibility, right? It's basically the Fed losing its credibility as kind of like, the monetary god or whatever, however you want to describe it, right? And so a related worry was that if the committee were too slow to alter its forward guidance, perhaps it feared an outsized market reaction or a loss of credibility. Again, the credibility part. Because if you think about it, that's pretty much all the Fed really has. Um, when you start to look more into how the system itself works, it kind of brings into question just how much power, at least in application, um, central banks really have. And that's one of the kind of larger and longer term questions I've been trying to answer for myself through all these videos and such is, how much power does the Fed actually have? Are they really some all kind of powerful entity to where they can basically control financial markets and all that just like that? Or are there also some kind of extraneous and we'll just say extraneous situations which actually have more um, sway on it. Basically, the Fed's actions the cause of certain financial events, or are they just one of the symptoms of some underlying dynamic that's even more fundamental, right? And that's where it kind of turns to shadow banking and the Eurodollar system, and really trying to understand how that functions, so that you can kind of see the Fed actually how the Fed actually influences the markets and such. You know, does it actually do anything? And if so, to what degree? But that's kind of more of a longer term question and kind of a search for understanding, right? And so I read that. So perhaps I already did that part as well. Sorry, I lost my spot. So monetary policy could be more likely to fall behind the curve if they were to basically lose their credibility. So, in this regard, one cost of providing explicit forward guidance would be a loss of the flexibility needed to respond to changes in economic conditions as required by the pursuit of their price stability and maximum employment goals, right? And so, as you think of this, it's kind of this whole loss of credibility and mostly the flexibility aspect of it, right? Is they don't want to if they're too explicit, they kind of paint themselves in a corner to where they lose the flexibility by being explicit of what they can do if needed, if situations change, especially in kind of a volatile economic environment as we are in now, or if they aren't so, I'm sorry, if they're that explicit and they change anyway, then they can lose credibility. Or if they don't want to lose their credibility, they have to basically force themselves to stay there when it may or may not be the best course of action for kind of monetary policy as a whole, right? And so you kind of have this catch 22 to where either way they're not in a good position. It's a lose lose situation. So basically, she goes on to talk about some of the other ways the Fed has become more transparent, kind of giving them more tools for this forward guidance. Kind of like in 1999, the FOMC began to release a public statement after each of its meetings, not something that used to be done before then. And that's one thing that I've found out was, and I thought was pretty interesting, was this kind of these public statements and that sort of thing from the Fed and the FOMC. These are, in the grand scheme of things, rather recent developments, right? Considering that, the Fed was the Federal Reserve Act was passed in November, I believe, of 1913. And then its first day of actual operation wasn't actually until 1914, right? So that's still, they've been open for over a century, just over. But it's still, we're talking about starting in 1999, so only 23 years ago. That's 90. So that means 75% of the Fed's existence, they didn't have these public statements. And now that could be, and this is just like the regular meeting ones, right? So there's probably other things throughout that time, but monetary policy wasn't such a big kind of public situation, I guess, as it is now, to where, really like retail investors get much more into it. To what degree, not 100% sure, to be honest, but it's still one of those things. This is a rather recent development given the grand scheme of the history and such. Right. And so she also brings up in 2000, in addition to describing the current policy decision, the post meeting statement contained a paragraph on the balance of risks. Right. And basically, it was meant to assess the risks of heightened inflation pressures and economic weakness in the foreseeable future. So, kind of putting in their mandatory or congressional mandate in that respect. And so, keeping that in mind, I basically already talked about this paragraph a little bit with how, with the Fed funds near their zero bound, that for explicit forward guidance was pretty much the only thing that they could do for the most part. And it was also the fact that, there was nothing to lose, right? Because it was basically obvious of where they had to be, and that it seemed pretty obvious in terms of kind of the grand scheme of things that they were going to that rates were going to be low for longer, as you start to see here, low for longer policy. And so, in a way, explicit forward guidance was seen as providing monetary accommodation when the current setting of the Fed funds rate could not, right? So it was kind of a check down per se in that respect. So, in addition, with the risks to the outlook generally seen as tilted to the downside in the years that followed the financial crisis, using explicit forward guidance to signal for a longer or low for longer policy was not seen as posing significant risks to the committee's credibility because they didn't really have anything to lose, because short term interest rates were generally expected to remain unusually low for those years. And the Fed funds rate was basically at the zero bound for years after 2008. I believe it didn't actually pop up until, I think, the very beginning of the Trump administration in like 2016. It was either that or the very end of the Obama administration. Without looking at a chart, I don't have an exact date, but it was around that time frame, kind of late 2015 and early 2016, right? So, keeping in mind, they also, because of this, they had kind of an escape clause, and that they kind of talked about in the December 2012 statement, where the committee noted that it expected the target range for Fed funds to remain at this 0 to 0.25% for at least, quoting, at least as long as the unemployment rate remains above 6.5%. Inflation between 1 and 2 years ahead is projected to be no more than half a percentage point above the committee's 2% lower run goal or longer run goal, so the 2.5%. And longer term inflation expectations are well anchored. So, what their typical stuff is in terms of especially inflation expectations. And we've talked about quite a few times about what could happen if those expectations became unanchored, and it's not a pretty sight, right? And so, To continue, she'll focus on two features of the current environment that she sees as explicitly relevant for assessing the role of explicit forward guidance as a monetary policy tool, right? And so the first was basically that inflation is unexpectedly high and the resulting urgent need to remove monetary policy accommodation. The Fed funds rate is no longer near zero. So now they kind of do have the Fed funds rate to move around as sort of another form, as another tool, right? It's not kind of, the market doesn't expect it to be within a certain range for quite as long. And there's more uncertainty from the market's perspective in terms of what they can expect from it, right? And so the second one is the inflation and economic activity is especially uncertain, and talks a little bit about recession risks and that sort of thing. It's basically kind of general uncertainty in an economic sense, which kind of accentuates their need for this flexibility in monetary policy. And so they don't want to paint themselves in the corner like we talked about a second ago by being too explicit with their forward guidance, right? And so here's the range bound for the Fed funds rate. Basically, they have that as a tool again. Just skip over that. Yeah, here's kind of what I was saying. High uncertainty about the outlook puts a premium on flexibility. So it's really kind of the emphasis that she wants to put on the reason why they can't be as explicit with forward guidance, right? And kind of historically looking back, one might reasonably argue that during that time, the committee's explicit forward guidance for both the federal funds rate and asset purchases contributed to a situation where the stance on monetary policy remained too accommodative for too long. So even as inflation was rising and showing signs of becoming more broad-based than previously thought, right? So basically, they were behind the curve, and that could be one thing that maybe they might kind of overcompensate in the other direction and keep them too high for too long or too restrictive, right? Keeping it above their kind of neutral rate, so to say, which would be or will be interesting to see in the next coming, I don't know, year and a half or so, I'd assume, somewhere in there. Kind of relaying a bit more on that, how they should have probably, started raising rates sooner than they did 2021, but it's kind of neither here nor there. So, and basically that the explicit use of forward guidance should be kind of used sparingly from now on because given the current environment, they need to emphasize that flexibility in their policy decisions rather than kind of hand holding the market in a way. So finally, to conclude, under current circumstances, however, the best we can do on the public communications front is first, to continue to stress our unwavering resolve to do what is needed to restore price stability. Second, as Chair Powell noted recently, we should acknowledge that the outlook for inflation and economic activity is subject to unusual uncertainty, again emphasizing the need for flexibility, and therefore they'll be making their policy decisions on a meeting by meeting basis, which we've kind of already been seeing anyway. And so, third and finally, they should continue to reiterate that we will remain highly attentive to inflation risks because that's pretty much all they've been talking about, especially with the kind of quote unquote raging hot labor market to where their whole employment part of the mandate is not necessarily deemed important at the moment. I don't know if I'd say important, but it's not deemed necessary to have action for it right now, right? So with that being said, I'll put a link to the speech itself in the description so you guys can read it for yourself. This one doesn't have a watch live link, so that's it. You can basically read it unless you can find it on some other outlet. But anyways, I'm going to leave this one here. So I hope you guys have a good night, and I will see you on the next one.